Now, in this video, we're going to talk about developing that risk management plan that suits you best for fundamental analysis. So, off the bat, it is unrealistic to think that you're going to buy a new house or buy a new Bugatti from 3 months of forex trading. You need to think of forex like a business. Think about your current income. Wouldn't you be happy earning an extra 20 to 50% from forex trading a year? If you earn 20 to 50% extra every year for 3 years, it's going to compound. And that compounding can equate to a new car or even a down payment for a new house. Fine, let's get more aggressive. Imagine increasing your account size by 10% every month. Within a year, you are going to double that account. Think of it like a business. Within a year, this is how some professional forex traders replace their current income. So it's all about finding out what are your long-term trading goals. It has to fit your lifestyle, your financial goals, and your personal experience. This is now how you set your risk tolerance. Now, at FT9ja, we have a maximum drawdown of your initial account balance of 10%. That means that you cannot go below 10% of your initial account balance. And that is a pretty strict rule. That is the ones that every trader that is with FT9ja, they abide by. But who's to say that you can't be stricter on yourself? Imagine having a weekly absolute drawdown for yourself of 3%. That means that every time, or as you're about to approach that 3%, if you pass 3%, if you lose 3% of your account balance, then you stop trading and you revise your risk management. You take back control. By having stricter standards for yourself, you can be well within the standards of FT9ja or any other prop firm. And let's talk about daily drawdown now. At FT9ja, we have a daily drawdown of 5% your equity balance. Now, as a fundamental analysis guru, you should not be risking 5% on a single trade or in a single day. Why? If you want to meet your goals of 20 to 50% a year or 10% a month, all you really need to trade is maybe 0.5% to 1.5% per trade. That way, you're well within the limits. You're well within your drawdown limits, your risk tolerance. You don't have to worry about blowing your account or losing your hard-earned money. So setting your risk tolerance is all about knowing yourself and knowing how much you are willing to lose. Now that you understand your financial goals for the long term and your risk tolerance, you need to calculate your position sizes very accurately. This is the practical part. This is the trading itself. Because if you're able to understand how much of your account balance you are willing to risk per trade, you can now set long-term plans that you can stick to, that you can now use your risk management to employ. We do this by using risk-reward ratio. Meaning, if I'm risking 1%, I would like to gain 4%. That's a risk-reward ratio of 1:4. If I'm risking 1:3, or 1:2, or 1:1.5, what I'm doing is setting myself up in such a way that one good trade can cover multiple bad trades. That's how having a good risk-reward ratio, that's what it does for you. Knowing these basics, it goes without saying you should always set your take profit levels, set your stop loss levels, and keep yourself up to date with market events. Over time, you're also going to be able to control your emotions better. And as you continue trading, you get better at sticking to your risk management. So I encourage you to learn more about risk management. You can do this by checking out our dedicated course on risk management. Thank you so much for watching. If you did not know anything about risk management for this video, I'm hoping that now you know that risk management is one of the key pillars, in fact, the key pillar for long-term trading, for taking profits along the way, for enjoying a wonderful forex journey. And it's not about the goal, it's about the process. So I'll see you in the next video.